Hi everyone, thank you for watching Speed Home Ringgit Hack Show. I'm today host. My name is Paul from Speed Home. Thank you so much for and welcome everyone to our Speed Home Ringgit Hack Show. So today we are very honored that we are invest on ProsperUs by CGSCIMB. So that's it. Like today we have two speakers. So the first one is Mr. Tim Phillips, and another one our another speaker is Billy. So later on I will introduce them more. But before that, right? So can I know any one of you that this is your first time that you join Speed Home webinar? If this is your first time that you join Speed Home webinar, can you just type 1? So if you join more than one time for our webinars, can you just type the how many times that you have joined, the numbers? Thank you so much, guys. Thank you so much. I saw some our old friends. Yeah, thank you. Mr. Lim Jit Hao. Thank you so much, Mr. Lim. Thank you for saying hi. So this is very important, guys. When you guys just type, even if you type a hi, a good evening, it's very important for us because we know we are not talking to the air because we're not really can't see you guys, right? Thank you for being engaging. Thank you, Mr. Lim. So the guys friends from Facebook. So later on we also have we will start our event, okay, at 8:30 sharp. So guys, if you have time, can you just help us to share it out so your friends also have the same opportunity with you to learn something from our guests today, our speakers today. So they were going to share with us some very what I'm saying is very professional insights, okay? Because both of them they are working on the ProsperUs, and they are before they working in ProsperUs, they are also a very outstanding financial writers. So guys, so don't if you don't want to miss these opportunities, please stay tuned. By 8:30 sharp, we will start this webinar soon. So before we start this webinar, so just let me play a couple of video regarding about our company services. Yep. So see you guys later.
Hello, I am landlord. Hi, I am potential renter. And I am Speed Home. Wow, so cool. Editing only ma. Okay, so why should we use Speed Home? Why? Give me reason fast. I very busy. I got meeting with Dato later, you know. Well, let's start with you first. Oh, okay. I'm interested to rent this guy's property. So can I take a look first? Oi. I where got time to go show my 10 properties to everyone. I only want to see one lah. Oh, sorry. Which one out of my 10 properties you want to see? No worries. We can arrange for our home runner to go to any of your 10 properties and take photos and videos and even arrange home viewings for any potential renters like you. Or free. Free. Oh, okay. Then if I like the property, can I rent straight away? Whoa, wait. I need to know his background first, After he no job cannot pay rent, how? Hey, you think I know money? Don't worry. We will do a complete background check to make sure the tenant is eligible and you get a qualified tenant. I don't mind. Check lah. But how is the deposit? Is it 2 months? Yeah, the deposit. This one very important. After he damaged my property and ran away, how? Hey, you think all of us very bad, is it? You own 10 properties, then you know lah. Can you come closer a bit? I want to slap your face. Guys, there is no deposit. Huh? Wait, where can no deposit one? Simple. The tenant only needs to pass our zero deposit eligibility check, and the landlord can sign up for the best insurance protection with Speed Home. Not bad no deposit. Wait, what insurance is this? It's Allianz Insurance that protects your right as a landlord. So just 1.5 months rental for the whole year, and Speed Home guarantees on-time rental payment, protection against rental loss, plus utility and household coverage. Oh, how much is the total coverage? Up to 42,000 ringgit. Wow, not bad. I can get money back. That means I can relax at home and you count him everything. Count him everything. Sign me up now. Me too. Great. Any other questions? Got free gift? We don't have any free gift. Can I give discount? Yeah, give free voucher lah. No free gift lah. But actually, you can advertise your property with us for free. And our insurance also have 60 days free cancellation. So no harm to try. Can I give free umbrella?
Hi guys. So right now I'm going to play a second video. Just take a minute.
Hi, I'm Wei Ming, founder and CEO of Speed Home. I founded Speed Home because of my personal problem. But I think my personal problem, you can relate to it as well if you're a landlord or you're a tenant. So number one, I started it because of my personal experience to lease out my house. I SMS 50 agents back in 2016 and only 10 replied to me and 2 actually post up the listing for me and eventually got listed up. So from 50 to 2 and to 1, it's a lot of people that I need to contact to. So I was wondering, why isn't there a platform where we can give you the control, empower you to lease out your house yourself, right? And Speed Home, basically, we provide you end-to-end solution. You just need to list your property, and then we help with tenancy agreement signing digitally. We help with rental collection, and more importantly, we have insurance protection. When I started this business, nobody really wanted to fund us. No venture capital wanted to fund us. In fact, there was a VC that told me, don't waste your time, Wei Ming. You should do something else because this business doesn't make sense. But I think because I know the problem that I'm feeling would be felt by many people, so I thought I should continue.
Hello. So today we are very honored. We have invited Tim Phillips from ProsperUs, powered by CGSCIMB, and also same as well, Billy came to be our Speed Home webinar speakers. Today we are going to talk about how navigating your investment in the post-COVID world. Yeah, sure. That is some things that a lot of things changes over the past years. But before that, let us just welcome Billy and also Tim. Guys, if you just you're watching our live, can you just type a hi or a thank you or just say a good evening to both our speakers. And also as a Speed Home host, I also very appreciate, and also it's such an honor that we are invited Billy and Tim. Can you just just say hi to our audience?
Hi. Hey guys, how's it going?
Yeah, so it's very different, right? Is when you talk online, you try to do some engaging stuff online. Then it seems a bit awkward, but I really get used to it. Almost 2 years. The last 2 years at Speed Home, we have hosted more than 60 webinars. So today, just let me to give very quick introductions to our today's speakers. So our first speaker is Billy. So he will share with us some outlook or some things that we should know about the macro markets in the world, like how it will impact Malaysia's or the region market. So this is some things that Billy. So Billy basically is my old friends that I know when I was still working in Central Daily as a reporter. So but right now Billy are investment writers in ProsperUs and also CGSCIMB. So in the meanwhile, we have Timothy Phillips. And Timothy, he's head of content and investment lead of ProsperUs. So, guys, ProsperUs. So, if you don't know what is ProsperUs, just give you a very quick brief. ProsperUs is a digital investment services launched by CGSCIMB in Singapore in this year. So, this is a multiple investments platform. So basically, I think later Billy or Tim, they will explain more on the platforms. But in the meanwhile, after they share the insights. So Billy and also Tim, I pass the stage to you both. Yep.
Thanks,
Thank
Paul.
you.
Yeah.
Thank you.
Yeah.
No worry.
Let me just
share my screen first.
Yeah, no
One
worry.
sec.
So let me change the outlook also. Okay. So Billy, yes.
Okay. Can you all see the screen?
Yeah, I can see it.
But I can't go to slideshow though.
You try.
This is okay.
Hmm?
Is it okay this way? I guess it's still okay, right?
Yeah.
Okay, so basically this is just the standard disclaimer. All right, so just take a quick look at it. Okay, and before I start, I'm just gonna briefly explain a bit about ProsperUs. Now, basically, sorry, we are a new digital investment service created for millennials by millennials. Now, we are multi-asset investment services that is created for digitally savvy millennials who are driven to do better in life and in personal financial management. Now, what you can do from our platform is that you can actually invest in multi-asset, multi-market, and in multi-currency. Now, at the forefront of our business, we focus on empowerment our individuals by bringing investor education to the forefront of our business. So if you can see from here, you can see that our focus is on millennials, and we aim to provide you with the best-in-class service in terms of the platform user experience. We are committed to educate you with the right investment knowledge. Now, Tim and I have spent a bit of time on this, and we think it's important, especially as some of us get caught with the euphoria of trading, amidst the bull run, especially for those of you who have invested in some of the US market and some of the overseas markets. And of course, you could complete your ProsperUs experience through a range of specially curated activities, range from lifestyle to dining. Of course, this is more as applicable if you are in Singapore. Now, sorry. Yep. So invest on the go. So you could actually find us on both Android and Apple App Store as well. And of course, we are available on all social media sites, basically all Instagram, Telegram, Facebook, YouTube, LinkedIn, and Twitter. We are still not at TikTok and Snapchat at this point, but you can find out more about us on our website by scanning on the QR code above if you want to, or you could actually search on the ProsperUs on Google. I'm not going to take too much of your time, so I'm just going to jump right to it. So navigating your investment in the post-COVID world. Now, the first thing that I want to talk about is how the global economy has rebounded from the worst recession since World War II, especially last year. Now, I think this is very important as we talk about 2022 because there's such a big disruption in 2020 when COVID-19 pandemic hit every one of us. So if you look at the chart here, you can actually see that in 2020, there is a negative 3.4% contraction. Now, that is the worst recession since the World War II, which is 1897. Now, if you look at my chart, it's only up to 1960. That just shows how far back, the decline in terms of the economic in 2020 and the sharp disruption from COVID-19. Of course, last year we saw a rebound in the economy where the global economy rebounded to 5.5%. Now, of course, going forward for this year and next year, analysts consensus are that the global growth will slow down.
You're still on this first slide. I'm not seeing any new slides coming up.
Is it?
Yeah. So I don't know if
Yeah,
you're...
Billy, the slide is not.
Slide, there's
It's
nothing
not moving. Yeah.
Yeah.
Let me just. Thanks for telling me. I'm not sure about that. Let me just share again.
Yeah. Okay.
Okay.
Yeah.
Can you see it now?
Now,
Yeah,
can you just test it out? Like move to the next slide.
Yeah. Maybe.
Yeah. No problem.
Okay.
Yeah.
Sorry about that.
No worries.
So, what we saw in 2020 and 2021 is one of is an event that doesn't happen very often, and of course, this disruption has caused a difficult scenario as we go forward because we have such a strong rebound in last year. But if you look at the next slide, you can see what I meant because the economic recovery is very uneven. If you look at global growth is driven mainly by the advanced economies, and of course, the emerging market has lagged behind, and we expected it to remain the same over the next 1 to 2 years. Now, what has been driving the recovery in 2021 is basically the COVID stimulus packages. So if you look at these charts here, this is actually as of May last year. So there is about 26.5% of GDP that is spent on COVID to fight against COVID in US. And that just shows the amount that the government is willing to spend to drive the recovery in the economy. Now, if you look at Germany, is at 35%. France is at 12%. The European Union is at 12%. So, but if you look at China, it's only at 5%. India is only at 3.5%. So you see the willingness of the developed countries and, of course, the capacity of them to spend as well as compared to the emerging market, which has driven the recovery that we saw last year. Now, this chart here shows the fiscal and monetary policy that has driven the recovery in the US. So if you look at December 2020, real money has shot up by 25% year on year. And of course, while it has moderated down in June and September recently, it has still remained on a positive growth level from a high base. And of course, if you look at the US budget deficit, in 2020, there is a negative 15%. And of course, US CBO forecast for 2021 is at about negative 13%, which is still significantly higher than what is expected for this year, which is about negative 4 to negative 5%. Now, if you look at these charts here, it shows the US Fed balance sheet. It has actually been more than doubled to US to 8.8 trillion as compared to the 4.2 trillion in the pre-COVID era. So it just shows the kind of money that is in the market, how the Fed is willing to actually allow the easy monetary policy to continue at that time in order to drive the recovery last year. Now, this year, we are looking at a transition to normalcy. And I think it will be a transition that is going to be abrupt in a sense that it's going to affect the market. But the structural growth story for some of what we are talking about will remain. Now, if you look at the next slide here, you can see that what I meant by transitioning to normalcy. There are more than 9.7 billion doses of vaccine that have been administered today. And if you look at the next chart, you can see how the entry restrictions and conditions have changed over time. Now, back in March 2020, before the COVID hit the rest of the world, you can see that there is not much data available and the restrictions are not much either. But in May 2020, you can see most countries are in a deep red except for a few. Then in July 2020, we saw some reopening at the Middle East as well. In September, this is followed by Brazil. Then, of course, if you look at November 2020 data, you can see that Middle East has reopened. And even China, for example, it has turned to a yellowish, right? But if you look at in January 2021, it has actually turned back to pink. Now, what I'm trying to show you here is that while we are transitioning to a normalcy, there's a lot of uncertainties that remain. Now we talk about the Omicron variant, and of course, while things looks to be better now, nobody can really forecast correctly how things will develop, at least over the next 3 to 6 months, right? And if you look at this, is the latest January 3rd, 2022. You can see that restrictions are eased even with the emergence of new COVID variant. Now you can see that in US, a lot of the countries are already in yellow, while in China it's in pink. Middle East is also broadly in the yellowish. Of course, there are still quite a bit of deep red countries, but if you read the news development, there are a lot of countries that are eager to move towards gradual reopening. Now, one example, you look at Malaysia, is how we actually started talking with allowing people to travel from Singapore to have easier entry into Malaysia from this country. So these are some of the things that we are expected to see. But now the next slide is probably something that you guys have been aware of. Novak Djokovic, the top tennis player, was actually deported from Australia after the vaccination roll. Now, what I'm trying to show here is that despite the gradual shift towards normalcy, we are still in a place that there's so much uncertainty. If you follow the news, you can see that regulators have actually allowed initially the court has actually allowed Novak Djokovic to continue, but then the Prime Minister actually exercised his right to deport Djokovic from Australia because of the vaccination issues. Now, that aside, whether you are believe in vaccination or not, my point is that we are in a place where there are so much uncertainties that as we shift towards normalcy, we are bound to hit with a lot of bumpy ride along the way. Now, if you look at this is the number of patients in hospital in US that is at a record high in recently. Now, this is due to mainly the Omicron variant, right? But if you look at the next slide, it shows that the hospitalization is mainly for fully vaccination. It's mainly for those who are not unvaccinated, while those that are fully vaccinated has actually remained low. This is the COVID-19 hospitalization rate in New York. And if you look at this, is the Google mobility data for those at retail. So I show Malaysia, France, United States, Germany, and United Kingdom. You can see that there is a decline in terms of the mobility because of the recent emergence of Omicron, but it's not as bad as what we saw back in February last year, right? It's also not as bad as when we saw in February 2020. This shows that we are trying to live with COVID-19 despite of the uncertainties that remain. Now, which points to the next thing that I'm going to talk about, which a lot of people are afraid of. Because of the strong recovery that we saw in 2021, US inflation has hit 39-year high of 7%, and this has actually set the stage for policy normalization. Now, of course, the inflation is also driven due to some of the supply chain shortages and blockages at the logistics area. But while the Fed initially talked about it being a transitory inflation, it looks like the high inflation rate is here to stay. So what's next, right? What we're expecting to see is the end of the ultra stimulus era. Now, inflation is no longer just transitory, as I mentioned about it. The Fed has actually changed that tone that they have been talking about almost the entire of last year. So that is something that has probably caused the market to react at the beginning of this year, as most of us are aware of. Now, monetary stimulus is being withdrawn and rate hikes are expected. Now, if you look at the chart on your right-hand side here, you can see back in June, right, there's only like expected the Fed rate to increase by 50 basis point until the end of next year. But by the December FOMC meeting, we are expecting a 4 rate hikes or 100 basis point increase by the end of this year itself. So it just shows the shift in terms of the expectation that there is among those who are managing the monetary policy because of the concern on the high inflation. Now, deficit stimulus will be reduced. So as I've shown you just now, you can see that people are expecting 2022 to see a much lower fiscal deficit. So this will also lead to a reduction in terms of the support on the fiscal front to drive the economic recovery. Now, the US Fed's three-pronged assault on the spiraling prices. Now, the US Fed has actually talked about three methods. Most of us are aware of the first two, which is to reduce the amount of government bonds and mortgage-backed securities it buys each month from 120 billion to zero by March this year. The next one is to start raising interest rate, as I have talked about just now, expecting between 3 to 4 rate hikes in 2022 and 2023. Now, the third one is the one that I wanted to highlight, which is during the meeting, the Fed policymakers have actually started to discuss a third measure, which is to reduce the size of the balance sheet. Now, you saw the 8.8 trillion US Fed balance sheet just now, right? So in order to reduce this balance sheet, what can the US Federal Reserve do? Now, first, they could actually stop replacing the bonds it owns when they mature. All right, that's the first measure. The second one, if the Fed feels a bit more confident about the economy, they're probably going to sell some of these 8 trillion plus bonds on its books before they are due for maturity. Now, what does this do to the market? I mean, most of us have seen the US Treasury yield went up and how it has actually affected the stock market and everything else. But what does it actually do? Right? It actually increased the amounts of bonds that other players have to buy because the US Federal Reserve will no longer be America's investors of last resort. So without US Federal Reserve buying this bond, there will be other investors that have to step up, and these investors will actually demand higher yield to compensate them. Now, this would lead to increase in yield, and of course, bond price will fall. So now the next question I'm going to ask is, how will this normalization, so to say, affect Malaysia? I mean, mainly because we are staying in Malaysia, so I'm going to focus on Malaysia. Now, rising yield will drive foreign funds outflow. I mean, it's not just in Malaysia, but basically in most EM countries. Reason being because if the yield in US is more attractive, then investors will probably not take that extra risk to invest in emerging markets such as Malaysia. So this is one thing that could have driven the foreign fund outflow. Secondly, the thing that I wanted us to take note of is that in Malaysia, the foreign selling has actually subsided in 2021 against 2020 and 2019. So you can see that the foreign selling, while remains, it's not as bad as what we saw in the last 2020 and 2019. And of course, last thing I want to show you guys is that foreign shareholding Malaysian equity market is near its lowest monthly level since the GFC period at 20.3%. Now, what this tells us is that while we do expect some form of foreign fund outflow, Malaysia is not going to be as affected because the foreign shareholding in the Malaysian equity market is already at one of its lowest level since the GFC period. Now, bear in mind, if you have been investing in the Malaysian market, you probably know that the IPM KLCI ended about close to its 10-year low at the end of last year. Now, the good news is that the recurring economy is in sight. Now, this is from the CGS CIMB research. They have actually projected that GDP will improve from 3.5% in 2021 to 5.6% this year. Now, domestic demand is set to become key engine growth driver after 2 low years. Now, if you've been following the Malaysian market, you will know that the domestic demand over the last 2 years have been fairly muted, right? And of course, on the supply side, construction and services, which is the worst hit sectors from the COVID-19 pandemic disruptions, are poised for a solid turnaround as Malaysia, as globally, we all try to shift towards a new normal, right? And the high vaccination rate in Malaysia as well, the rollout of booster shots, also brighten prospects of the reopening of the economy. Now, firm recovery is expected for domestic demand. I've talked about this. You can see that you can see public consumption is pretty low here. You can see that private consumption is low in the third quarter. Over the last 7-8 quarters, it has been pretty low. If you look at the blue line, you can see that. So we do expect to see some form of rebound as we enter into 2022. So that is some of the good news that we can really look into. Of course, like I talked about, construction and services will rebound with the COVID-19 disruptions waning. For Malaysia, we do expect to see a gradual monetary normalization amid mild price pressure. I think this is global issues, and the Bank Negara Malaysia is expected to raise OPR by 50 basis point to 2.25%. By the end of 2022. Sorry about that. So that's something for us to take note on. So how do we invest in the post-COVID world? Now, I'm not going to talk so much about stock pick, but I'm going to talk about something that we need to put our mind on. Now, first thing I think most of us really need to keep in mind is that always invest with a margin of safety. Now, I'm just going to share this story. I think most of you will probably know it. You don't drive a truck that weighs 9,000 pounds across the bridge that says the limit is 10,000 pounds because you can't be that sure about it. Now, when you are driving across the bridge because you know that you will fall, then you are afraid to do so. But when you're investing in the stock market, sometimes we don't realize that we are actually we have to take into consideration of the downside as we go forward in a world that is full of uncertainty as we transition into the new normal. Secondly, do expect volatility and profit from it. Now, imagine if you're doing business with a Mr. Market. Now, every day without fail, Mr. Market quotes a price at which he is willing to either buy your interest in the company or sell his to you. Now, the business that the both of you own is fortunate to have the stable economic characteristics, but Mr. Market quotes are anything but stable. Now, you see, Mr. Market is emotionally unstable. Someday he's cheerful and only see brighter days ahead. On this day, he quotes a very high price for shares in your business. At other times, Mr. Market is depressed and see nothing but trouble ahead. He would then quote very low prices for your share in your business. I'm sure most of us are aware of this because over the last 2 years, it's been pretty interesting, right? I think in 2020, the glove stocks shoot up, surged high to new highs. Of course, last year it dropped like nobody business. So the whole idea is that you should expect volatility, especially as we shift to a year that is so uncertain. We are not sure when the COVID is going to end, or if the Omicron, or if there will be any new variant that's going to come out. We are not so sure about the policymakers' decision. And of course, we are also very afraid of the geopolitical tension that we are seeing every day. So there are a lot of these uncertainties. And if you are investing in the stock market, you have to expect that there is a volatility and make decisions that benefit you instead of allowing the market to dictate your decisions. And of course, last but not least, know what kind of investor you are. Now, there are passive investors and there are active investors. Now, if you are someone who are busy with your work, for example, if you're a doctor, you don't have that much time to monitor the market, it's probably better to go for passive investing. such as ETF investing, because that will make a lot more sense for you because you don't have the kind of time to monitor the volatility in the market. But of course, if you are someone like myself, for example, if your job is to look into the stock market, so maybe you can consider active investing, right? So that's something for you to take note of. Now, I know that we all like to know what to invest in, so I'm just going to briefly talk about the 6 trading teams for this year in Malaysia. Now, the first one is, of course, the beneficiaries of the OPR hikes. Now, we talk about the rising interest rate, and of course, Malaysia is no exception. So, with the beneficiary of OPR hikes, we are expecting the players like Hong Leong Bank, Public Bank, and RHB Bank. Now, this is from the CGS CIMB research. And of course, the next one is the value and laggard plays. We expect to see Gamuda, Sime Property, Astro, Genting, and Dialog to see a rebound this year. Recovery plays involve players like Inari, Mr. DIY, Maiji, IHH, and Yinsen. Electric vehicles plays. I know that we all talk about EV, and of course, in Malaysia, it's probably more on the semiconductor players that are involved in the EV ecosystem, which includes MPI and Gentech Technology. ESG picks is also gaining momentum as the world shifts towards a more sustainable investment methodology, and CGS is looking at companies like Maybank, Hong Leong Bank, Telecom, MISC, and Sime Darby as a good pick for ESG teams. Now, high dividend yield companies such as Astro, RHB, Tenaga, Genting Malaysia, and Maybank will also be something that will come into play for this year. Now, key risks to watch out. Now, if you notice just now, I talked about the margin of safety, and I just wanted to highlight this before I pass my time to Tim. Now, the first risk that I wanted to raise is the policy mistakes that are likely to happen. Now, if you look at in China, they are still adopting the zero COVID policy, which is going to be threatened by the emergence of Omicron variant. So the lockdown will actually affect the supply chain globally. It will affect the economy in China. So these are some of the risks that we have to take into consideration, right? And of course, not only that, the US Federal Reserve is also one to take note of, whether they will raise rates too fast or too slow, right? So that's also another concern that we have to take into consideration. And of course, the prolonged COVID-19 disruptions, we all know that the Omicron variant at this juncture does not increase in terms of the death rate. But having said that, the risk of a new variant is still there. And of course, if the COVID-19 disruptions were to continue beyond 2022, then of course the impact on the stock market will be even more significant. Now, last but not least, for Malaysia market, I think political concern is also another area that we have to take note of. GE15 is just around the corner. Nobody knows when it's going to turn out, but we all have seen how uncertain the political situation in the country is, especially with the flip-flop of the government, right? I think over the last 2 or 3 years, we have 3 prime ministers. So that's something that really we have to take note of. And sorry, when I talk about policy mistakes, I also wanted to highlight on the geopolitical tension that we are seeing. So you can see that US, Russia, and of course, even in Europe, the Brexit that we saw, so these are things that we have to take note of and how it will actually affect the market, not only in Malaysia, but also if, let's say, you invest in your bonds or any other asset classes. So do take note that when you invest, always invest with a margin of safety. All right, I'm going to pass the time to Tim now. He's going to talk about the US tech stocks and, of course, the US market as well. And after that, then we will go into the Q&A session.
Thanks,
Tim,
Billy. Yeah, really insightful stuff. Let me just share my screen quickly. Okay, yeah. Can everyone see that? Yeah.
Yep.
Okay, great. Yeah, so okay, so first off, disclaimer, this is obviously just not meant to be construed as financial advice, so please do your due diligence and figure out what level of risk you want to take when you do buy stocks, and obviously do your own research. And this is my own personal opinion. Okay, so interest rates, right? I think we're going to take a look back on 2021, see what kind of market we had. As Billy mentioned, there's been a rise in expectations of interest rates. So you've got Jay Powell here, the sort of the boogeyman, so to speak. Winter is coming. Everyone's really scared. There's going to be 2 hikes, then there's 3 hikes, and now everyone's talking about 4 hikes, and they're even talking about a 50 basis point hike at the March FOMC meeting. So this is something that has really hit a lot of the growth stocks in the past sort of 8 weeks, I'd say 6 to 8 weeks. So this is something that has been telegraphed ever since late last year, so in November, December time. And so the correction has already started in a lot of the high growth names, and it's starting now to seep into the indices as well. So what's the actual story, right? So at the moment, this is actually from the end of December. So this is a chart from Denny Research. This is a really well-known research house. Obviously, the 10-year yield, the 10-year treasury, this is a bit dated because since the end of last year, the yield has risen to about 1.85. So it's actually a lot higher. But as you can see, the S&P 500 earnings yield is at about 4.3%. So as long as you've got that spread, as Billy had said, a margin of safety, but this time in the market, the margin of safety is basically the spread between the 10-year and the S&P 500 earnings yield, then hopefully you're not going to see a recession or some sort of major sell-off. And so at the moment, that margin of safety is looking at about 2.3, 2.5%. If it goes below 2, technically that's a time to worry. So historically, that's been a time to worry. So let's see where that heads. But for the moment, a lot of the market sentiment right now in the US is being driven by that 10-year treasury and where that's headed. And obviously, because the risk-free rate is heading higher, people are pulling money out of growth stocks where a lot of the cash flows are in the future. So you're seeing a lot of the rotation out of growth into value stocks where you have the cash flows that are in today, and people are finding safety in that and finding solace in those types of names. And so if we look back on 2021, we can actually see the S&P 500 as a whole was driven mostly by the mega cap stocks, which again is not really that surprising, I guess you could say, because for the past sort of decades in this bull run, the mega caps have had a really amazing time, especially in the tech world. And so you kind of see this chart here, looking at about 5 of the big tech players have driven about sort of over a third of the S&P's 500's gain, and that was in late December. So the S&P actually had a really great year last year. It was up around 27% in terms of price return. I think total return was maybe 28, 29%. But anyway, it had a really great year. And a lot of that came from the likes of, Microsoft, Apple, Google, Nvidia, which was up, I think, over 120% in 2021. So again, a really big outperformer. So you're seeing those types of companies having driven returns in 2021. And a lot of the growth, really high growth stocks, sort of the pandemic plays, so to speak, that you saw do really well in 2020, they got hit very badly in 2021. So I think the outperformance of the big tech giants has actually masked a lot of underperformance and a lot of selling, or a lot of negative returns in a lot of the other areas of high growth, which you can kind of see here. So I'll bring it onto this. So this is a really good table to illustrate how great the returns were in 2020 for some of these names. So you can see the green column with the returns from 2020 in terms of price, and then see how that switched in 2021 as stimulus came through. It started to fade off, and then you saw this realization, I think, in the market that rates were going to go up, and they were going to probably go up this year, substantially. And then so I think once that realization hits the market, a lot of these names got sold off really hard. But having seen some of these gains, as you can see, some of them were up at least 300-400%, many up even more than that. So for them to take that sort of haircut or that drawdown, I think was not exactly surprising. But I guess the speed and the scale of the drawdown has been quite shocking for some people. So a lot of these names may not come back, but a lot of them, if you are invested in quality over sort of 3 and 5 years, and you're confident of the business fundamentals and how it's performing, then it's something that you just, I guess, have to ride out and be prepared for. And so valuations have also come down. So you've seen a lot of valuations. This is a really good chart that shows valuations in the SaaS sector and in the cloud stock sector. So you can kind of see heading into early sort of January and February last year, there was a really big spike in a lot of the growth names. That hit about, in the high growth high growth median for cloud was over 40 times sales. So the EV to next 12-month revenue. So that has come down and it's about half. It's at half that now. And I think there's still room to run in some of these high growth names in terms of the sell-off. And you saw yesterday coming back from the long weekend for the US market, there was a big drawdown again in the NASDAQ and the S&P. And you're seeing a lot of these growth names continue to fall. And so I think if they start coming back towards pre-COVID multiples, that's when you're looking at something maybe approaching value in a sense, but that's not going to happen for some of these high growth names until it comes down another 20-30%. So this is something that you can be fully prepared for. But if you're a long-term investor and thinking about the longer term, then this again could be a good buying opportunity for some of your favorite stocks. And so how far will the Fed go in hiking, right? So I think what Billy had mentioned was the amount of rate hikes that they've got going and the amount of stimulus that they've put into the system. So that's something that you have to really consider as well with the Fed. And so the Fed is really going to have to think about how fast it can raise rates, because if you look on the left-hand side chart, how much debt has been taken on since the global financial crisis and how that's also been turbocharged by the pandemic and how much more stimulus has been pumped into the economy since then, the global economy. And you kind of see how much global debt has risen. It's approaching $300 trillion. And so how much can they raise rates without impinging on the ability to service that debt? That's a question that the market's going to have to figure out. But I don't see personally a scenario where the Fed funds rate is at 4 or 5% in 2-3 years, because that would make it really, really difficult for the government to be servicing debt. So it's something that the Fed will have to think about carefully. And on the right hand side, you can kind of see there's always going to be choppiness around Fed rate hikes. There's always a bit of uncertainty, especially with inflation at the rate that you're seeing, 30-year high. But if you're thinking that inflation will eventually maybe settle, obviously it's not transitory, but if it does settle at a lower rate, maybe in the second half of the year or early next year, then I think these next 5, 6, 7 months could be a time where, averaging into the market or using a passive index fund or an ETF rather, or buying some of your favorite stocks, I think that could be a good decision over the next sort of 3-5 years. You could look back and think this was a great opportunity to enter the market at a much more preferable level than you had seen in the past sort of 2 years. Okay, so in this environment, where do people want to go, right? I think money talks. You've kind of seen that with a lot of the deals that have happened recently. I mean, last night you saw Microsoft announce that massive deal for Activision Blizzard, and they have cash. That was an all-cash deal. So as you can see with these tech giants, the amount of cash they have on the balance sheet, net cash, they can afford to go out and buy things, buy companies. I think Microsoft is going to get a bit of regulatory scrutiny, but at the end of the day, these companies are buying back shares. They're paying out better dividends, at least Apple and Microsoft are. And they're very able to do that because they have massive operating and free cash flows. They have massive profits. They're extremely profitable, and their moats at the moment don't seem threatened, at least in their sort of, their prime business areas. And so what a lot of people are focusing on now in terms of the businesses they own, as you can see on the right, is just a short, quick list of some of these things that people want, right? I think last year, when you're looking at, so 2020, you're looking at companies that are losing a lot of money, but still growing that top line at crazy rates. That now focus has shifted a bit towards, is this company operating and free cash flow positive? Does it have cash on its balance sheet? Does it have little debt? Is it net cash? Does it have a good balance sheet? Importantly, in rising inflationary environment, does it have pricing power? And how big is this moat, right? So I think if you had invested in nearly anything in 2020, you probably would have made money. But nowadays, I think there's going to be a lot more selection on what kind of businesses actually have pricing power and what kind of businesses can charge more and have a competitive moat against in the industry. And finally, switching costs. I think a lot of these major tech players, as you know, if you're into Office or if you're locked into iOS or the ecosystem in Apple's phones, you're not going to switch, right? So I think they've got that hold on switching costs, and they've got a very good competitive position. So in this environment, you're even seeing people think of big tech as defensive, which is totally understandable. And speaking of pricing power, it does matter. I think pricing power matters. On the right, it's just a little joke you have about education. I think the education industry, if it was an actual sector in the S&P 500, would probably be way off the scale. If you see how much education prices or university prices, schooling prices have gone up over the past 40 years, they have incredible pricing power. But on the left-hand side is a pricing power index score that was devised by UBS. And you can kind of see actually that in terms of the US and the S&P 1500, you wouldn't expect, I guess, financials and energy to be at the bottom, but they are in terms of how they can raise prices. But if you're thinking about a company that is maybe in IT or communication services now includes obviously Amazon and Facebook, or now Meta rather, and IT obviously you've got Apple and Microsoft and all the big tech guys, is that a lot of the capex, or they don't have a lot of capex rather, so they're not capital intensive. And in an inflationary environment, that's great. Whereas maybe energy is a bit more capital intensive with investment. And so the amount of money that they're going to have to spend to sort of maybe retain customers is a lot more than what you'd think of from maybe a software perspective or a tech perspective. So that's something to keep in mind going forward and thinking about pricing power, because that's really going to matter a lot more in this year, especially with the transition towards higher rates. Okay, so I kind of want to just touch on why growth investing still remains relevant. I think everyone's been a bit scared off, obviously, by the massive drawdowns that we've seen in the past sort of 6, 8, 10 weeks, which is totally understandable. But we kind of have to think longer term about why we're still invested in these companies, why we like them, and where we see them going in the future. So I think growth should be in every portfolio. I've just got a quick list of what you think of as growth, but growth should be in your portfolio because I think it really is the future. If you're thinking about where your stocks are going to be in sort of 5, 10 years, and unless you're really close to retirement, you should be a bit more conservative, and you probably won't have as much growth. But if you're say under 40, I think growth should make up a significant chunk of your portfolio. And so what would characterize growth? I think you're looking at fast revenue growth. You're looking at a huge TAM, which is really important, total addressable market. And so focusing on areas where there's a lot of promise and a lot of more growth to come. So e-commerce and fintech, I think, like digital healthcare, I think these kinds of areas have massive addressable markets where there are going to be multiple winners. So there's just the importance of identifying them and understanding the landscape. Thirdly, you want to be focusing, if you're thinking about outsized gains over 5 years, you want to be focusing on companies that have maybe sort of smaller market caps or mid caps. So if you think of an Amazon or an Apple or a Microsoft, they're already over 2 trillion or 1.8 trillion to nearly 3 trillion in Apple's case. And so how much further can they grow? They'll still grow well, I think. But in terms of adding value, could an Apple 5x in 5 to 10 years? It's unlikely that you're going to see Apple become worth $15 trillion or $12 trillion or whatever in 5 years, right? So that's really difficult. Whereas if you're looking at a company which has a market capitalization of maybe 20 billion to 30 billion, and for them to get to a market cap of 150 billion, the value that's created is a lot less. So it's a lot more feasible and a lot more attainable for those companies, as long as obviously they're executing and they're in the right industry and they have a really good business model. So that's something to keep in mind when you think about longer term returns. And obviously right now, current prices, they're going to be based off future cash flows. So you have to remember that in this environment with growth, even if businesses are doing well and they're performing well, they're going to be punished in this rising rate environment. And that's something that no one's going to be able to tell you when the bottom is. You're just going to have to be comfortable. If you do want to buy into a company and you're comfortable at the price, then I think that's good enough for your own sanity in your portfolio. Okay, so why invest in growth stocks? I like to invest in growth stocks because I like to own the disruptors in businesses, right? In industries. I don't want to own the winners of yesterday. I don't want to own the oil companies that are not going to be growing, revenue. They're not going to be growing their sort of total addressable market unless they pivot and find new sources of revenue, right? You want to be owning companies that are going to be able to pivot and going to be able to grow their revenue in new ways, and they're going to excite you. So I think what you want is companies that disrupt, because companies that disrupt incumbents tend to be ones that have a lot more vision in terms of long-term success. Second, the share price appreciation is there. You have to look at the total return. So if you're investing, again, I love dividend stocks, but if you are investing in a dividend stock and it's yielding 8, 9, 10%, don't look at the total sort of dividend yield. Look at the total return from the stock price plus the dividend, because that will tell you a lot more about the business and how it's done. So a great example that I like to use, I mean, I'm from Hong Kong, so I invested in Hong Kong a lot. A lot of these Chinese banks and big oil companies, they're always got 8, 9% yields. Some of these Chinese PetroChina and Sinopec, the likes of those guys have like 8, 9% yields. Everyone's always saying, oh, they're great, 8, 9%. Look at their price chart over the past 5, 10 years and figure out, if you had put however much money into sort of a Sinopec or PetroChina 5, 10 years ago, how much you would have today. And it's not pretty, right? So I think it's important to remember, you want to look at share price appreciation and total return over time and how that allows you to create the wealth that you want to create for your portfolio. And then long-term time horizons, right? You have to allow that company to grow. If you're investing on a 6 or 12-month basis, then it's going to be more difficult because you're going to have to be trading. And so it's a very different mentality to investing longer term in growth. Okay, so this is just a little gift that I like to use with stocks dropping 50% or more. You have to be willing to accept that when you talk about growth investing, because that happens a lot. You saw Netflix drop about 80% in 2011-12 when they moved to online only streaming. So Amazon has dropped 30-40% multiple times. So these are things that just happen every so often with some of the best companies in the world. But you have to identify, obviously, are they going to win over the long term? So that's the hard part. But if you do invest in these types of stocks, you have to be prepared for these kinds of drawdowns. If we look at Netflix, I like to use Netflix as an early stage example. It's been a business which was primarily focused on the US, and everyone thought about the US as being, the be all and end all of the business. But actually, if you think about the total addressable market for Netflix or any massive US tech company nowadays, the TAM is actually global. I mean, ex-China, right? Because we have the Chinese tech ecosystem, which is China only. And then we have the US tech ecosystem, which is US and rest of the world, because the rest of the world uses US tech, whereas China just uses China tech. So the TAM for US tech companies is actually that much bigger. And you've seen that with the international growth on the right-hand side. You saw even in the second quarter of 2016, over 50% of revenue came from the US for Netflix. You swing to the second quarter of last year, over nearly 2/3 of revenue now comes from 60% of revenue now comes from outside the US or US and Canada. So you kind of think about how that shift has taken place and how Netflix has grown with the international business, and you can kind of see how a lot of these tools that we use every day for either work or for enjoyment or social, a lot of the tech tools are originated in the US, right? Not a lot of it originates in China, at least not on the software side. So that's something that I think we need to think about when we think about tech and US tech in particular, is the reach of the tech is actually very, very substantial. So one of these, I'm going to just quickly hit one of the themes that I really love, which is e-commerce. China is a really great high penetrative area for e-commerce, but I think it's more saturated. You kind of see that on the right-hand side. As a percentage of total retail sales in China, online is set to pass 50% this year, right? So that's big, that's huge, but is the growth going to be there for the likes of Alibaba, JD, those giants? You're not so sure, right? Whereas retail e-commerce in the US, even with the pandemic bump, you're still seeing around 15 to 16% of retail sales being carried out online. So the amount of growth that is there for e-commerce in the US on online sales is huge, because the majority of it, nearly over 80% of it, is still carried out in physical retail stores. So you're kind of thinking, how much more growth is there in e-commerce in the US? And there's plenty. So I think that's something that we should keep in mind as well. And so for me, one of the ones that I really loved for a long time is Shopify. I think it's sort of the digital storefront provider. If no one's familiar, they basically are not consumer facing. They help merchants basically put up a store online, and they make it very, very easy for them. So they've got over 1.75 million merchants worldwide. They're a global player. A lot of their merchants currently in the US, but they're expanding obviously into Europe and in Asia. And they're just getting started, right? They've only got a 9% market share in the US of online sales. Whereas if you think of an Amazon, it has about 38, 39% share of online sales. And so they sort of are the anti-Amazon. They're trying to help the SMBs put out their wares direct to the consumer. And so they can help build the narrative. So they've really been able to grow the business from, just an online store, simplified online store to, point of sales, Shopify sort of capital, helping their merchants sort of with working capital, then shipping, fulfillment. They've done a lot of tie-ups with companies like Facebook Shops, with Walmart, with TikTok. And then if you've just read the news yesterday, they actually signed an agreement with JD.com. So they're going to allow their US merchants to start selling into China, but partnering with JD on logistics and currency conversion. So it's the sort of the runway for these kinds of companies that can kind of do that is humongous. And so Shopify is a great example of a company that's really been able to pivot into new areas like payments, and they haven't really fully hit their stride yet. So that's a company that I'm watching closely during this sell-off. Okay, so I'm just going to quickly cover lessons, for picking the tech winners. You want the large TAM, the total addressable market. You want the first mover advantage, which I think is important in the US. In China, it might be a bit different because first mover doesn't always win in China. In China, it's fiercely, competitive, and there's always iterations and things change. But in the US, first mover, if they manage to gain that critical mass, they tend to do really well. Optionality is crucial. That's really important for companies that are going to change, your portfolio or really make a difference to your portfolio. They need to be companies that are going to find new ways to make money. Amazon, think of Amazon and Amazon Web Services and how that really changed the fortunes of the company. Founder-led firms, that's something that, aligns their incentives. They're really protective of their company. They want it to succeed. They're not just driven by that pay package. They want to, really help solve problems that they've seen in the world. And then finally, winners win. I think quality can sometimes cost money if you're thinking about whether that's big tech, if you're thinking about maybe whether that's the really, really best in class e-commerce, fintech companies. Usually over time, the quality will tell out. So I think that's important. And then finally, there is some selections of things that I find really useful personally for resources if you're thinking about exploring cloud, or if you're thinking about exploring tech in the US. There are some really great resources out there, right? So Clouded Judgment's a great source for just valuations in cloud stocks. IO Fund, which is a newsletter from Beth Kindig, which I think she's one of the best tech analysts I've seen in terms of the tech space, and she really understands the areas, and she does free insights in the newsletter. FinTwit can be interesting, but be selective in what you're following. I'm on Twitter, but I'm not super active, but I follow a lot of different voices, and there's some really interesting opinions and charts out there. You actually just come across some really great content. And then, podcasts. I think there's some great ones like Invest Like the Best and Business Breakdown. So just go out there and just use a lot of the resources out there, because there's some really great free content out there to help you sort of dig into the nitty gritty of tech. So I'll leave it there. I think I'll end my show there and hand it back to.
Yep.
Yeah. Hand it back to you guys.
No problems. Thank you, Tim. Thank you for sharing about the tech insights that just now that you have shared. So yeah.
Sure.
So guys, please just don't ask. Later on, we're going to jump into the Q&A sections. But before we start, so just don't ask like, is it this kind of stock that we can invest or not? So perhaps this is not a very good a stage for you to ask this kind of very directly. But in the meanwhile, guys, so right now we are going to enter to our Q&A sections. So you can just type your questions. But before we jump into Q&A, right? So before we start our Q&A, right, I will take a 5 minutes time, just like have a very quick brief about our Speed Home services. So So just give me like everyone, just bear with me with 5 minutes. I will just share with you like what is Speak Home about. Thank you. So okay, I'm gonna share the screen right now. Okay, guys, if you can see the screen, the poster, okay, that is a two handsome men in poster. You can just type 1, so I will know. Yeah, you guys can see the screen. Okay, thank you so much, guys. So for the first timers to join Speak Home services, so today I'm going to share with you about Speak Home. So actually we are the free posting, okay, website and app for you to have if you have a house to rent or you want to rent a house. If you're a landlord, you can just upload your properties details, and then you can have a free listings, okay, advertisements for your house rental. So in the meanwhile, we will provide a free viewing services in Klang Valley area. So if your house is within Klang Valley areas, most of the Klang Valley certain area we didn't cover for the home runner services. So yeah, but you can just always check with us. So after we show the house to potential tenants, right, you can just have a tenant. We will help you to check about the tenant background to make sure they are the good payment master. We have some credit scoring. We'll check on their credit scoring, their where they work, everything. So we will do a background check. After we finish a background check, right, we will have a online digital tenancy agreement. We will create an online digital tenancy agreement for both of you, tenant and landlord, to sign it up. So after we successfully get you a tenant, then we will ask the landlord to pay us a month of the rental to just purchase an insurance to protect your house. And we help you to do the free rental collections as well. So Speak Home, okay, we are the safest end-to-end property rental platform. So actually, we are the 100% local, okay. Our founder and CEO, Mr. Wong Wei Ming, he started Speak Home during 2015. So we rebrand ourselves in 2019. So currently, our app downloads is more than 550K, and we have a monthly traffic around 220K, and we have more than 100,000 property listed in our platform. And also, we have a 600K of the tenant inquiries. So basically, if you search Speak Home with all the mainstream media in Malaysia, you'll find our brand. Actually, our company is already interviewed by these medias. So we have raised total 70 millions over the past 5 years. So we have a lot of, you see, this is like quite substantial companies such as IJM, Allianz, and also a venture capital fund, Gobi Partners. They're all our investors. In the meanwhile, Joel Neo and Yo Chin Chua, the Faith co-founders, they both are our early investors. So yeah, just to let everyone know. So during our rebranding, right, we have invited former IJM CEO and also former Allianz CEO and our former local governments and housing minister YB Zuraida to be our grand opening guests. So what is Speak Home so different than everyone else? So the first things that we provide better quality of the tenants. We use the credit scoring tools to screen out the tenants, the bad tenants. So we provide the direct communications. The tenant and the tenants, they can just check via our app or web chat. And we provide zero deposit by offering Allianz insurance to protect the landlord and to ease the tenant financial burden. So number 4 is we provide the viewing management, and we help the landlord for a free rental collections. So a lot of the landlord, maybe they will feel like, wow, why I should use the Speak Home for the zero deposit? Am I like taking a lot of risk? No, basically the zero deposit will help you to maximize your tenant portfolio, and basically it's no risk for you. If anything happens, the insurance will cover your loss. So your property will be always the first choice for your house, your property. Can you imagine that if that is the 200 unit in a one condo is going to rent out, those who 199, that is they require 2.5 months deposit, and you rent with zero deposit. Not only like you rent out your house so many times faster, but in the meanwhile you are going to avoid the price war. So this is some things that the zero deposit going to benefit the landlords. And our insurance package is definitely the coverage and the protection is so much higher than the traditional deposit. So actually, as Speak Home's insurance, we have 2 packages. So today I'm going to just very focus on one packages that we offer. Is about Extended Plus package. So the Extended Plus package that have two features, right, is only offered by Speak Home in the market. The first one is Overstay Cash Defender. If we give you a bad tenant and they didn't pay the rent, we'll pay the rent until the tenant move out. And in the meanwhile, we'll absorb all the court order fee. So this is the only things that the only services that offer in the market. We are the only one. So how much that we charge by offering this kind of services? So it's equivalent to 1.5 months rental of your house. So this is this is the features that we have. But if you think right, you are trusted our screening, everything's so good. So this is a one month to the 1.25 months packages. That's the coverage is lower, and also this is without the over cash stay defenders. So the last two things I'm going to share with you guys. The first one is like actually Speak Home, we built landlord communities. We call it Association of Landlord Malaysia. So this community that built by us is totally like free. Okay, free to now. Currently, this community we have 5.8K members. So if you are a landlord or you want to just like understand about more Malaysia's properties, you want to seek for any kind of the advice from community, this is a group that you should join. So you can just search Association of Landlord Malaysia, or you can just take a snapshot of this slide. Yeah, this QR. So in the meanwhile, Speak Home, we also have our Telegram channel. We started our Telegram channel. All our latest event we will share in our Telegram channel. Yep. So, and right now, if everyone that will refer from Speak Home, we will give out a free AirAsia point. So what you need is just like log in to be our user and just share to your friends. If they successfully sign in as our users, you will get a free AirAsia point. Okay, so basically I think from the Speak Home services explaining everything just here. So guys, now we came back to our Q&A sections. So let me check around. Is any of some of our friends that is asking? Yep. Okay. So this is the first questions here. I think Billy or Tim, both of you can take these questions. So will the China government crack down on the domestic tech giant? It will benefit the Southeast Asia's regions. So this is some things that this is a quite macro questions. So Billy or Tim, who are going to take these questions?
I think the Southeast Asia countries will benefit to a certain extent, but it really depends on what you're talking about. If you're talking about the crackdown on the tech players, then because most of the Chinese tech players, they are very domestic oriented, so the impact might not be there. But you're talking about some of the issues revolving, say, the US and China trade tension and all that. Those might really benefit some of the companies in Southeast Asia. I think we know the RCEP that was signed that will come into effect this year, so that would actually benefit some of the Southeast Asia players as well. So it really depends on what sort of regulatory crackdown that you're talking about. At least that's from my point.
But if we talk about like from the foreign investments point of view, so I think that a lot of foreign investors, right, they are kind of like a bit shocked on the how uptight I would say the China government's on the tech, on the regulations, everything's. Yeah, will eat this kind of the foreign investor, the outflow will benefit the Southeast Asia market.
I think we have seen that outflow even in last year. We have already seen that. So a lot of that has already happened. In a sense, I think a lot of that has been priced in. Whether this will continue or not, it depends a lot on what the Chinese is going to do. I think what we're seeing today is that the consensus is that the Chinese crackdown is really for the long-term good of the country. So that fear is there, but there are also those who have already started to go back inside to take advantage of the lower valuation that we have seen over the last 1 year. Yeah.
Noted.
I would just add that I think it's good for Southeast Asia from the economic perspective. I mean, there's definitely going to be more investment, and you're seeing that from the likes of Japan and the US and Australia. I think because of the geopolitical importance of the region versus China. But from the capital market perspective, from the stock market perspective, it's a bit harder to gauge how much more popular markets in Southeast Asia will be. because from a liquidity perspective, you're looking at the Hong Kong exchange and the Shenzhen and Shanghai exchanges are just really big, humongous in terms of the daily turnover and all that kind of thing. So, and there's still a lot of interest in China as a whole from institutional investors and international investors. So unless I think maybe one of the markets here can really stake a claim to compete with the likes of Hong Kong or Shanghai, some of the big companies here like Grab, they've not listed in this region, they've listed in the US. So it's a bit harder for, I think, the markets here to maybe make a big claim. But you're definitely seeing more companies come out of this region, which is great. I mean, a lot of local tech companies like Grab, like like Tokopedia from Indonesia. So I think there's definitely that positive sort of side effect of that.
I see. Noted. So the second question is is here. It's like they actually there's this users that they're asking, do you agree the Chinese tech sector worst is over? So means like the crackdown, everything's like regulations. Is it because in the meanwhile, 2 days ago, there's this I talked to another fund managers, right? He seems like it's quite positive, and then he thinks like there's a lot of opportunities on, especially in the tech sector in China, because seems like a lot of the companies, right, they are choose to obey the Chinese government, the China governments, and seems like that everything is just it's going to be business as usual. So yeah, may I know, do you think both of guys, what's your thought on this?
I think for me, from a investment perspective, the China tech giants, their best days are behind them. Like when I look at China and Hong Kong, I'm not that interested in investing in them because they've had the whole of China to themselves to basically want to use WeChat or get people into Taobao and Tmall, and they've had the whole thing to themselves and they've managed to get a lot of users, and that's great. But their growth going forward is going to be severely restricted by antitrust and by the Chinese government. So they've amassed a lot of power, and because of that power, they have a lot of spotlight on them and they have a lot of restrictions placed on them. So I don't think the growth in the Chinese economy and the Chinese capital markets is going to come from the likes of Tencent or Alibaba. And also they're so big already. They're sort of at a market cap of 400-500 billion. They're not going to expand that much, and I think that's something that we tend to forget, is that they've already got so much, they've already got so many users and so many, they're so integral to the operation of the Chinese economy that my personal view is that I think they might actually end up being regulated like utilities. They'll be so important that the Chinese government maybe will cap how much they can charge certain products or how much they can do with certain things, with certain of their tools, that they're so important to the Chinese economy that I don't see the Chinese government just letting them do what they want. Whereas if you're talking about smaller consumer discretionary names or green energy and EVs, they're really nascent markets. And so to me, that's a lot less, and healthcare is another great area. Healthcare, these kinds of areas, there's so much more exciting growth available, and a lot less risk, I think, because the likes of Baba and Tencent and JD and Baidu and all these guys, there's just still too much risk around it, because I don't think the crackdown's done yet.
Even this is a very huge corrections on their share price.
Yeah, because who knows what the Chinese government wants to do next? Unless the Chinese government comes out and says, we're done, this is our announcement, this is my vision for common prosperity, and President Xi says, I'm done. You can now go back to business as usual. You're never going to know. It's just going to be a gamble, right? So why take that risk? Why not go into areas that are going to have great structural growth, and there are still really great companies in China, right? So that to me is just seems like a natural choice.
So how, Billy's, do you share the same thought with like Tim's?
I think Tim has a lot of point on that front, but I do agree that just to point back, I think when you talk to a lot of the consensus view is that the sell down is overdone. But I think what Tim is really referring to, which I kind of agree, is that there's a lot of uncertainties in Chinese if you want to invest in China. So the way I will put it is this: if you are looking for, say, if you never have any exposure in Chinese market before and you wanted to try to invest into the Chinese market, then I think it's probably something that you can consider. But I think at the end of the day, investing is very personal. It can't just be because you think that the market is there, gonna rebound, and then you want to buy into it. You got to look into what your whole investment objective is. So yeah.
Okay, noted. So come back to the this is a question that my personal question. So right now, right, that this is soon we're gonna to embrace a 5G world. So the 5G is gonna come in, but that seems like this is also have some noises. Like today, this is just a news for the a lot of the flights like cancel, and then the associations, like certain of the association of the aviation industry, they kind of like against for this 5G technology implication. So may I know, right? Do you think like is it that it will hold the whole 5G, the whole 5G opportunity or something?
I think the 5G story is something that is a long-term structural growth story, which is going to continue. I mean, of course, depends on which market you are in. Of course, if you're in China, I think the 5G development is already underway for quite a while. If you're in Malaysia, it's probably something that we are just starting to talk about. I'm not so sure about Singapore. But I think the whole idea is that yes, there are going to be some hiccups around, but at the end of the day, you gotta look at the value add that this new technology is gonna bring to it. I'm just gonna bring one of Tim's stocks that you talk about often, like Apple, for example, right? If you follow the news recently, in the Apple app developers actually generate about 60 billion US dollar in revenue. So my point is, if we are looking at technologies that can help a lot of other players to generate huge economic benefits and add values to society. So I think that's what we are really going to focus on. And I think 5G offers that. So regardless of some of the hindrances that we see, I think it's a structural story that will drive the tech sectors going in the long term. Yeah.
Yeah. I mean,
Great.
you remember the days when you had to like put your phone off and go into airplane mode, and you know,
Yep.
you can't, yeah. Like in 3G and 4G days, like, I mean, nowadays, does it really matter whether you have your phone on? Like, probably not, right? So I think they'll figure that out, like in you know, maybe in the next few months or a year. I'm sure they'll figure out how to
Yep.
stop 5G interfering with
True.
planes.
So
and also to work, I think.
okay. So that is another question also for me. So Bailey, just now you share about like this is a 6 sectors, right?
Yes. Yeah.
That talk about. But can you just share more on the ESG? Because I think this is also for Malaysian investors, right? They were gonna to they are kind of curious, like what kind of the industry or sectors, right, we're gonna take impact by these ESG issues. So can you just share with us about this kind of the lines?
I think ESG is something that is, I mean, it's not just a sector specific. It's going to be something that will be the focus on. I think if you look at even on Microsoft latest acquisition, a lot of highlights is on the some of these, I think the work conduct, and activists. So that is a concern on the front, right? I mean, you look at Malaysian stocks, you saw the glove sectors, for example, right? They were affected because of some of the foreign labor issues as well, right? I think some of the tech players, the semicon players in Malaysia were also affected. I think the focus is that I think people realize that at the end of the day, ESG is not something that is just it's not just a word that people use for the sake of driving marketing or whatever. It's something that
Branding,
drives
yeah.
real benefit. Like I talked about just now, for example, right? I mean, I mentioned Apple just now. I'm just going to go back to that because if you look at it, companies that bring values to society actually will eventually be doing better themselves. Microsoft is another story that I think Tim talked a lot about, right? Because if you look at the fact that they are B2B, they actually empower a lot of small businesses to do things. I mean, if you look at even, for example, Facebook, I'm just going to talk a bit on the US companies first. Like, it also makes sense because despite of all the regulatory issues, Facebook has actually empowered a lot of small, medium enterprises. I mean, if you look at in Malaysia, you look at, we're talking about telecom, we're talking about MISC, Hong Leong Bank, Maybank, some of these big players that have actually taken steps to really address some of the ESG issues, especially in terms of the way that they conduct business. I think these are areas that we need to look into. Of course, I mean, being a Malaysian, I think I have to say this, that I'm skeptical on a lot of things when it comes to things that are being released. Sometimes you do have that, but having said that, if you look at even companies in Malaysia, we are also playing catch up on this front, and I think this is an area that will also happen in Malaysia, where companies will realize that it's important to actually grow sustainably. So it's no longer just a team that's for marketing purpose. It's something that has real meaning in our society.
I see. Noted. Yeah. Tim, do you have any things to add on regarding about the ESG?
Yeah, so I would agree with with what Billy has said, and I think you do have to really dig into what each company is doing on the ESG front. But I think the E is going to be much more important over the next sort of 3-5 years, like immediate term. I think the S and the G, we've always been concerned about governance in Asia, and I think there will always be governance issues wherever in developing Asia, but you just have to watch out for that. But the E is something that I think everybody can benefit from, right? So the company is going to save money by decarbonizing or finding an area where they can use renewables, or they can reduce their carbon footprint or reduce their power bill and save money. That's going to be huge, right? So maybe that's going to be a tangible benefit straight away, but you also have to have the infrastructure and the supporting sort of investment there for that to happen. But if it does, I think you're seeing in Thailand already a lot of investment into green energy, into renewables. They're really making headway in Thailand. So I think there's nothing to say that Malaysia or Singapore is doing a lot. Malaysia, Indonesia, Philippines as well. They can't do more with renewables. And I think companies that show that they're really trying to cut down their carbon footprint, or they're trying to decarbonize and they're saving money and doing good for the planet, that's a win-win situation for everybody.
Understood. Thank you, Tim. So guys, here I'm going to announce like a very generous things that ProsperUs that you offer to Speed Home users. So guys, that is a link that we are going to share on our comment sections. So if you sign up Prospector account today and get you will get 100 cash credit. Of course, terms and conditions apply. So please just click on the link that we are going to share on our comment sections. So you can just easily apply and then just type the promotion code that already stated in the landing page. So yeah, please just if you are looking for like overseas investments, right? Multiple currency with multiple assets. I think Prospector US is a platform that you deserve to just explore it. So if you have any questions, anything, so also feel free to just go to ProsperUs website, and you will find like if that is the kind of services that they offer, then maybe it suit to you. So yeah, so everyone, so almost we come to the today sections, and so Billy and also Tim, do you have any the last sentence that you want to share to our audience? Yeah, or summarize conclusions.
Just check out prosperus.asia. Yeah, sign up. Like you can access some pretty good terms for US markets, and then obviously you can access Hong Kong as well and Singapore. So check it out. And we've got a lot of our content from myself and Billy on prosperus.asia, a lot of free content. So please go and check that out.
Okay, just check out the link, and also don't forget, if you sign up via this link, and you will stand and you will get a chance to get a 100 ringgit. Yeah, terms and conditions apply. Yeah, Billy.
Have a good night, guys.
I love you all.
Yeah.
Thanks, everybody.
Okay. Thank you so much, guys. Thank you so much. Bye-bye.
Bye.